All right, if you're an AI founder who's about to walk into a pitch meeting, you need to stop and listen to this first. Seriously, the playbook that got startups funded in 2023, that playbook will get you laughed out of the room in 2024. We're going to break down exactly what's changed and, more importantly, how you can win in this brand new environment.
So what is the big change? Well, to put it simply, the AI gold rush is over. The party's ended. Gone are the days when you could show up with just a cool idea and a slick pitch deck and expect to walk out with a check. The rules of the game have been completely, and I mean completely, rewritten.
And this slide right here tells you the entire story in a nutshell. A year ago, you could walk in and say, "Look at our user growth. It's a hockey stick." And that was enough. Now investors are going to look at you and say, "Okay, but what's your compute cost per user?" They want to see the math. They need proof that your business is actually sustainable, not just a bonfire for cash to get users who might never be profitable.
So you might be wondering, how in the world did we get here so fast? I mean, this wasn't some slow, gradual change. This was a really sudden, sharp correction in the market. Let's take a look at the timeline to really understand the why behind this new reality.
You know, it all started pretty quietly with GPT-3 back in 2020. Then, boom, ChatGPT launches in late 2022 and the floodgates just burst open. 2023 was the absolute peak of the hype cycle. Money was pouring into companies that, let's be honest, were often just thin wrappers on existing tech. But in 2024, the party's definitely over. The market is sobered up, and now investors are laser-focused on just two things: defensibility and efficiency.
Investor Sonia Huan put it perfectly. She said, "The battle is shifting from the model layer to the application layer." What does that mean? It means having access to a powerful AI model isn't a competitive advantage anymore. That's just table stakes. That's the price of admission. The real question, the one that gets you funded, is what unique, valuable thing are you building on top of it?
Okay, so if the old playbook is totally useless, what does the new one even look like? Let's get right into the specifics of what VCs are demanding in an AI pitch today. These aren't suggestions. These are the new non-negotiables.
First thing you need is what's called a proprietary data moat. And think of it like this. If anybody can build your exact product just by plugging into the same OpenAI API that you use, you don't really have a business, you have a feature. Your unique, exclusive data is your castle, and you've got to prove to investors that your walls are high and that your moat is deep and full of crocodiles.
Second, sustainable unit economics. This just means knowing exactly how much it costs you in total to serve a single customer. And this is the key part. That number must include your AI compute costs. Think of compute as the electricity bill for your AI's brain. If it costs you $1 in that electricity for every 50 cents a customer pays you, you don't have a business model, you have a money pit. You have to prove with cold, hard numbers that you can actually make money on each user.
So this slide kind of pulls it all together. These are the 5 pillars of a fundable AI startup in 2024. You need that bulletproof data strategy we talked about. You need a meticulous compute cost analysis. You need a top-tier technical team that can actually build this stuff. A super clear path to monetization, and finally, a really convincing answer for how you're going to defend your business when the big foundation models inevitably get better and cheaper.
All right, now let's talk about the single biggest reason AI pitches are getting shot down today. It's a term you need to understand and, frankly, avoid at all costs. It's called the thin wrapper trap.
This is the question you have to ask yourself, and you have to be brutally honest about it. Are you just putting a pretty new user interface on top of someone else's technology? Because if the answer is yes, then you're building on rented land. And right now, investors are terrified of that kind of exposure. And this table just lays it out so clearly. A thin wrapper? It's easy for anyone to copy. It has an incredibly low barrier to entry, which means your great idea today could literally be a minor feature in their product tomorrow. And naturally, VC interest in that is fading fast. A defensible moat, on the other hand, is built on your own unique data and your own proprietary workflows. It's hard to replicate, and that is where investors are putting their money now.
Okay, so we've talked about the problems, we've talked about the pitfalls. How do you actually build a winning pitch for this new environment? Well, it all comes down to 3 key pillars.
First, quantify your moat. Don't just talk about it in vague terms. Show investors the actual data that proves you have a truly defensible business. Second, master your costs. Walk into that meeting with a detailed spreadsheet of your unit economics, not some back-of-the-napkin guess. And third, Prove your path to profit. Show them you thought deeply about how you're going to make money, not just how you're going to get users.
And that brings us to the final and really the most important question. It's no longer enough for your AI to be powerful or clever. The technology? That's just the entry ticket. VCs are now asking a much tougher, more critical question. Is your business powerful? Is it truly built to last? That is the question you have to answer to get funded in 2024.